Stocks are continuing upwards. We got Bitcoin riding a wave of greed and fear, and yet hidden behind all of the numbers, Trump threatens new tariffs on Russia as high as 100% if they don't back off. The Fed's future is at stake with Powell's fate, and the AI-fueled rally meets earnings. Let's unpack it all with all of these moving pieces. So what we see with stocks is that overall, more optimism. They're still trending up with the NASDAQ 100 tiptoeing around their all-time highs. Today we had Bitcoin hit a new all-time high, reaching as high as 123,000 before trending back below this $120,000 mark. And I'd imagine a lot of people are just taking profit with as high as it's gone, but I wonder what the next stop for this cryptocurrency will be. And the trend doesn't stop there. Up for stocks, up for Bitcoin, up for the dollar, which has had one of its worst years ever. And then at the same time, the VIX is also up. So what's trending down right now? It doesn't really matter because it's up, baby. We're going to the moon. Now let's look at the fear and greed index for the stock market, which has just hit levels of extreme greed. But wait, there's more. What about the crypto fear and greed index, which has just hit greed up here at 70? It was just at 68, and then we just passed that threshold, hitting 70 today. And with crypto being the star of the spotlight, it's broke to a new all-time high. MicroStrategy has continued buying up more crypto. So what's really moving all of this? Well, it's really around 3 bills being considered by the House of Representatives this week, with this week being called the Crypto Week in Washington. And some of the bills being considered are the Clarity Act, the Genius Act, and the Anti-CBDC Surveillance State Act. And a lot of this is moving the, causing the moves we're seeing in the cryptocurrency market, as well as possible rate cuts down the line from the Fed, and then just this risk on rally that we're even seeing broadly in the stock market. So we'll continue watching this and sees what happens, but stocks may continue up on this AI excitement I just mentioned. And at the same time, there's low gas prices, which when you think about gas and how it leads into all of these different factors and industries for businesses, that leads to lower costs for businesses. And then this fiscal stimulus and deregulation from Trump with his one big beautiful bill. Tariffs' full impacts may not start to actually show up until late November, and this is for the full impacts of these tariffs, with the impacts of them beginning to show up as early as this week's CPI report on Tuesday. And we'll talk a little bit about that here in a sec. But let's talk about some of the positives we got for the stock market right now. UBS came out and said that it takes on average 105 days for the S&P 500 to pull back of at least 5% when it's at a record high. Morgan Stanley's Mike Wilson also said that investors believe that these announced tariff rates that we keep on getting, last week was completely busy with the tariff news, and I'd imagine this week won't be absent that news either, that the investors in this market don't believe that these tariff rates will be implemented, hinting at that taco trade. Trump always chickens out, whether they're blocked in court or whether Trump just walks them back, or maybe they see the optimistic Goldilocks scenario where they're settled and then they completely go away. His team also concluded that the big beautiful bill will bring down corporate tax rates down from the 20% to 13%, increasing cash flow, helping out the Mag 7, those real large tech stocks, and then allowing that to seep through the economy through that trickle effect. So what are we watching this week? Well, we got earnings, and even going forward, earnings are going to be super huge because everybody wants to see what the tariff impacts are doing. Are they taking tolls on businesses, consumers? Who's really paying these costs? And what are the guidance forecasts saying? Also, at the same time, what are CEOs saying on the company earnings calls, and how are they answering these questions around all of these various topics? Analysts have raised price targets for stocks in 9 of the 10 sectors last week for the S&P 500, with financials being the main winners of that. And this week we start earnings season for some of these financials. Speaking of them, so this will be the banks. Saxo Bank strategists mentioned that if banks show stable margins, healthy credit trends, and even modest improvement in lending or trading, it could confirm this soft landing view that everybody's kind of searching for, because it's really three scenarios. There's this soft landing where we're like flying the plane and we barely like land, like a baby could sleep through it. So there's no this hard bump or recession or slowdown in the economy where it starts getting kind of uncomfortable. There could be the no landing where we continue flying. Who cares if we run out of gas at some point? We just continue going and we really never go into a recession. We just keep on kicking the can down the road, or we crash. And this will be the hard landing. So a lot of people prefer this soft landing because that's maybe the healthiest out of the three scenarios I just given. And if there is this soft landing, that would be seen as possibly good, and it could also support current valuations in the stock market where we're currently sitting. But if rising costs or credit losses creep up, then markets may start to question the optimism in some of these valuations, and especially if we're starting to see consumers and businesses getting a little bit more risky with their credit, right? Not paying their bills, lending starts driving up more, and there's more need for credit usage, and then people not paying their bills and getting behind on their credit. And then the next thing we're watching will be CPI. And with CPI coming out, this is a big one because, like I said, everybody wants to know whether or not these tariffs are going to begin showing up in the data. So tomorrow we got consumer price index. We're expecting core CPI to come in at 0.3% year over year. And there's a couple expectations around CPI. It's expected to increase for goods. And a lot of people are mixed about this. Some think it's going to be sticky and last around for a while. Then at the same time, the same people will come out like a couple days later and be like, nah, just kidding. It's going to be like a one-time increase and we don't got to worry about it. So Wall Street economists are bringing down their forecasts for inflationary impacts due to these tariffs. And if CPI comes in hot due to, say, goods inflation coming in high, it could be ignored by the wider market view that it'll be temporary. And because services makes up most of the bulk of CPI, so the CPI report for services is about 57% of the read compared to the 20% for core goods, which strips out the volatile segments like food and energy costs. Now, on the other hand, if we're still seeing service-related inflation, and if this comes in pretty hot, that can be pretty alarming and really move both the market and the Fed's views as to whether or not we're going to see rate cuts, at least in July. Really, July's off the table, so if it's like soft or real supportive of a cut, we could change depending on tomorrow's move, but really July's off the table. We're looking at September's meeting. And if this CPI data comes in hot, and especially towards these service-related industries and sectors, then September could start getting unpriced as well as far as a rate cut goes. Now, where's the economy heading? We got a survey, and I kind of touched this on Sunday, I believe, and what economists are seeing is lower recession risk and stronger job growth. So let's get into this. Economists expect stronger growth in job creation, lower risk of recession, and cooler inflation than they did 3 months ago, according to the Wall Street Journal's quarterly survey of professional forecasters. And as we go through this, the survey gathered responses from 69 economists at outfits ranging from Wall Street banks to universities to small consulting firms from July 3rd to the 8th. So this is right around all of the news starting to come back up, and some of the main topics of this, some of the main highlights that I got is that they're seeing economic growth being a little bit higher, coming in at 1% in Q4, up from 0.8% forecast back in April. Near-term recession risk is now down to 33%, down from 45% just back in April. Like, this was just right around the corner. So almost 50% of recession unpriced. And I'd imagine this is from this Trumpian approach tariffs, then they're off, and then they're on, and then they're high, and then they're low, and then they're gone, and then they could possibly be blocked, and now they're back. And this is causing a lot of confusion and this thick cloud of fog that nobody can really navigate through. So honestly, all of this stuff is guesses, and I'd imagine if you ask these same questions right now, it'll all be completely different. Like the next one, inflation expected at 3% as of December, down from 3.6%. I'd imagine this one will for sure be higher. Overall, this next topic, monthly job growth seen averaging 74,070 roles, up from 54,619. So they're seeing more job creation, more job growth, companies to begin hiring a little bit more because of this certainty that we've gotten since early July, which is even more uncertain right now. But overall, all forecasts that we got from this survey are worse than they were in January. So although it's looking a little brighter at the end of the tunnel, it's still pretty bad. Now, what was the main articles moving the news and markets today? Well, my guy, it is Trump. And we got this video from Trump, and pretty much what he's saying is extremely strong tariffs will start in about a month, with levies at current levels already bringing in a lot of money. So we have tariffs pouring in at levels that we have never seen before, and they've only just started, he told reporters, a day after he announced 30% duties on the EU and Mexican imports. So this one's really huge because tariffs just don't stop with today. Russia was announced that they're going to get these huge tariffs against them if they don't back off of Ukraine. So what Trump said is that if they don't halt hostilities in Ukraine, that there will be severe tariff consequences if there's no deal in 50 days. And he said these rates could be at 100%. And he'll also do this as secondary tariffs. And the secondary tariffs can be done by, and I had to look this up. I don't just know all of this off the top of my head, all right? We're learning together. So a secondary tariff can be done by sanctioning any country that trades with Russia. And the 100% is far less than the 500% rate that the Senate was considering as part of the Sanctioning Russia Act of 2025. And then I got some more data on this. The U.S. imports from Russia the first 5 months of this year totaled around $2 billion, $2.1 billion. And some of the bulk of this was around enriched uranium and precious metals, making up the huge bulk of that. And then at the same time today, maybe yesterday, the U.S. reached a deal with NATO to send weapons and air defense. I believe it was called the Patriot, within days to Ukraine, all at their expense. It'll cost them about $10 billion, but they're sending support to Ukraine. And remember, it's at their expense. And when you think about this for markets, we can't really get a break because when you think about it, this is just another geopolitical event. And could oil prices rise? Can stocks start going down in reaction to this? And then I read some article earlier about how Israel just strikes somewhere. And all of these moving pieces, and on top of that, the confusion, and whether or not this grows into something much more impactful to the markets, because what we know is ignore that. That's usually in history, buy the dip, it doesn't matter, in a month later on, yeah. All of that seems true right now, but with all of these moving pieces, and with it just back to back to back, and then more layers getting stacked on more layers, and then the previous layer doesn't go away. It's like a big old huge cake made up of just a ton of mess for markets and investments and business owners and consumers all at the whole. And it doesn't stop with just Russia. So there's the European Union, which Trump said on Saturday that he was raising the EU's tariff rate up from its 10% rate they had up to 30%. And this led the EU's top trade negotiator to want to visit and speak with the U.S. to try and get something done, tone down some of these rates that were announced, saying that the 30% was prohibitive to mutual trade. They also announced they'd be suspending the retaliatory tariffs on the U.S. in hopes of reaching a deal pretty soon. And they seem pretty optimistic that they'll be able to get a deal done. But if it's not by August 1st, I wonder how that happens and what happens when this August 1st deadline comes up with not just them, but all of these other countries. And I believe for China, their deadline was a little bit further back. I believe it was closer to like August 12th. So China's a big contender here. But that's not to discount the European Union, like 27 countries in that. That's huge. They're one of our largest trading partners. So that in China, that's what a lot of people are hoping to hear news on. And we'll keep on covering this as it comes in. Now, let's talk about this. With Trump and Powell, he's still pressuring the dude to cut rates. He thinks rates are too high. Other central banks around the world are cutting rates. There's a dilemma here because markets could be severely disrupted within the first 24 hours if Powell is removed, like Trump threatens. Like 1 minute, we're going to remove him. Another minute, we're not going to remove him. And then another minute, he needs to cut rates. And then another minute, I'm going to announce a new Fed that will cut rates, pretty much. And Powell's removal or resignation can cause a severe downward volatility in both the dollar and markets, as it could damage all of it, and that damage could stay for a while. And this was paraphrased by ING's regional head of research, all around concerns of the Fed's independence. And then we get into this. The dollar could drop 3 to 4% on a trade-weighted basis. Treasuries could sell off, pushing yields up. And what we know about treasuries and treasury yields is when treasury yields go up, so do borrowing costs. And then borrowing costs get more expensive for who? Well, the government, businesses, and consumers. So that's not very good for the economy. And then another one, moves in so-called cross-currency basis swaps could make it more expensive to borrow dollars for these central banks around the world. So those are just some of the concerns people are saying. And then at the same time, Powell's not going to want to cut rates because he wants to keep the Fed's independence. He has his own legacy that he wants to fulfill. How did they put it? I lost it. It was probably in another article. I've read like, I probably read like 40 articles today, not even BSing you. But anyways, all of this is just more uncertainty to stack on top of everything. And with Jerome Powell being who he is, he said, hey, I would have been fine cutting rates earlier, but Trump's tariffs aren't making it easy. And because of Trump's tariffs, because of that meddling kid, I'm not cutting rates. And that's why we haven't cut rates. So we'll keep on watching this. It looks like the likelihood that the market believes of a Fed cut in September is falling. We were as high as 70%. Now we're right back at 60, which 60's over half, likely still there. It's really going to be dependent on this CPI data that we get coming out tomorrow. A lot of people are going to be watching this around the world. Investors, economists, analysts, company CEOs and bigwigs, and literally everybody. Moms and grandmas are going to be watching this, moms and pops. So we'll watch this. I'll report what happens together. Just meet me there. And in the meantime, everybody, hope you get some bomb sleep tonight. We got a busy day tomorrow, and we got a busy week this week. And it doesn't just stop there. It just keeps on going. So I'll see y'all tomorrow, y'all. Let's see what happens. Great luck out there, and I'll see you soon.